Last year wasn't a great one for Canada's major pension funds. Of the 4 big ones, 3, the Canada Pension Plan Investment Board, the Caisse de dépôt et placement du Québec, and the Ontario Teachers Pension Plan, all underperformed their benchmarks. They're hardly losing money. All 3 delivered percentage increases in their assets in the high single digits, retaining their status among the world's best managed pension funds. However, flush as they always are with new contributions, they have to deliver high returns. If they're to guarantee current contributors the same future benefits present beneficiaries now receive, and while their long-term returns are such that they can absorb a year or 2 of subpar performance, the risk is that this slump may not be a one-off. Apparent points of vulnerability lurk in each of them, particularly the CPP. The National Fund is especially exposed to the US, with half of its assets invested stateside. That bet paid off handsomely over the past decade or so, but it may look less clever going forward. Whereas European markets, for instance, have been rallying this year. The German index is already up by over 1/5. US indices are currently more or less where they finished last year. Many analysts expect that to continue. If history is any guide, US stocks may not grow by much over the next decade. The real problem, though, is this. Canadian pension fund managers have also invested heavily in private equity. In no small degree, the rise of private equity has mirrored that of the pension industry, as the latter has been the principal investor in the former. PE has been another star performer whose future now looks cloudy. One effective strategy of PE managers has been to take their investors' money, use it to leverage large loans, then acquire startups or struggling companies. Through restructuring and development, they then build them to be ready to go public once more, at which point they sell them on the stock market, pay off their loans, and distribute what remains to their investors. This approach produced bumper profits during the years when interest rates were low, not only because credit was cheap and abundant, but because it juiced the stock market, more or less guaranteeing a profit when PE investors exited their investment by selling them on. But problems began brewing 3 years ago, when interest rates started rising and payouts began to fall. Then last year, the slowdown in equity markets, especially the US, started to constrain exit activity itself. Fund managers have been forced to hold assets for longer, awaiting a resumption of market activity, which has yet to materialize. But investors still expect their cash payouts, so managers have had to resort to dipping into their credit lines or engaging in increasingly opaque deals, such as transferring assets across their own funds, when one subsidiary borrows cash to buy another, creating an illusion of an exit. To generate returns,